Alright, welcome to another screencast. We'll be looking at question 4 of the 2014 January Principle of Accounts past paper question. Alright, it reads, Mary Jane owns a small fleet of vehicles which she makes available to the general public for hire. On 1st January 2011, her limousine, which originally cost $90,000, had an accumulated depreciation of $9,000. If you're wondering about the accumulated depreciation, that is just another word for provision for depreciation. That really is the total of all depreciation on the item to date. Mary Jane provides for depreciation using the reduced and balance method at a rate of 10% per annum. A1. Calculate the depreciation expense to be charged for each of the 2 years ending 31st December 2011 and 31st December 2012. A2. Draw up the provision for depreciation account for the 2 years. A3. Prepare the fixed assets section of the balance sheet for the limousine as at 31st December 2011. Alright, so let's tackle A1. We're going to try to calculate the depreciation expense to be charged for 2011 and 2012. Alright, because we are using the reduced and balance method, we need to know two things. One, the cost of the item, and two, the depreciation to date on the item. Alright, the cost has been given as 90,000. The depreciation to date has been given as 9,000. Now, if we subtract these two figures, we would end up with a figure that is referred to as the net book value. Alright, so we subtract these two figures and we would get the net book value. Then we would multiply it by the applicable rate for depreciation, in this case 10% per annum. Alright, so if I were to just get a calculator, alright, so we have 90,000 minus 9,000, 81,000. So the present net book value at the start of 2011 would have been 81,000. Now if I'm going to multiply that by 10%, which is 10 over 100 or 0.10, that gives me a total of 8,100. So for the first year, the depreciation would have been 8,100. Alright, as you can see here, cost 90,000, depreciation accumulated, that would have been before the start of 2011, so the ending of 2010, 9,000, subtract, so you started 2011 with $81,000 as the net book value for the limousine. At the end of the year, the depreciation charge 10%. Okay, we move the decimal place one place to the left, so we got 8,100. We subtract these two figures, that will give us the net book value at the end of 2011, which also would coincide with the starting value for 2012. Again, we find an additional 10%. That's the new depreciation for 2012. Alright, always on the net book value, the existing net book value. Alright, that would have been 7,290. We subtract that, and at the end of 2012, the limousine had a total as net book value of $65,610. Okay, let's put that information into a depreciation expense account. Alright, now because depreciation is an expense, we would start recording item on the debit side. Alright, now depreciation expense is charged at the end of the year, so the date in use would be the 31st of December. Alright, we usually debit the depreciation expense and credit the provision for depreciation account. Now, because we're looking at 2011, the figure that we would use would be 8,100. Alright. Now, the balance on this account is not usually transferred to the next year. It is written off to the profit and loss account, or charged to the profit and loss account rather. 31st December. Alright. Okay. So that would be written off the account, and at the start of 2012 there would be no balance on that account. So let's repeat the process. For 2012 we saw that $7,290 was the amount for depreciation. So I'm going to just simply copy that information. 7290. Again, on the 31st of December, I'm going to close off the account to the profit and loss account. 7290. Alright, there you have it. The depreciation account for 2011 and 2012. Next, let us draw up the provision for depreciation account for the 2 years 2011 and 2012. Alright. Now remember, at the start of 2011, there was already a balance in the provision for depreciation account of 9,000. Alright. So we're going to start by indicating that on the 1st of January, there was a balance brought down of 9,000. Now, from the depreciation expense account, we saw that on the 31st of December, 8,100 was the amount for depreciation. Okay, so we put the credit entry here. 31st December. $8,100. Alright, that gives us a total of 17,100, which would mean on 31st December the balance carried down was a total of 17,100. Alright, this balance would be transferred to the start of the next year, which is 2012. Alright. So we have the 1st of January, balance brought down, which is the same as 17,100, and we saw again that on the 31st of December 2012, $7,290 would have been charged as depreciation. So let's complete the double entry. 31st December, depreciation expense 7290. That gives us a total of of 24,390, which would mean that the closing balance or the balance carried down would also reflect that total, seeing that it is needed to balance off both sides of the account. 2013. Balance brought down at the start of 2013, 24,390. So there you have it, the provision for depreciation account for limousine for 2011 and 2012, with the balance being transferred to the start of 2013. Thank you. Alright, let's complete part 3 of A. Prepare the fixed asset section of the balance sheet for the limousine as of 31st December 2011. Alright, because we're looking at a particular section of the balance sheet, we're going to prepare what is called a balance sheet extract. Now, an extract simply shows the part that is affected or involved in whatever transaction may have occurred. Alright. So the fixed asset we're looking at, limousine. The cost, as we know, 90,000. Now the depreciation on that item in the balance sheet would be the accumulated depreciation or the provision for depreciation, or simply put, the balance to date of all depreciation. Now we're looking at the end of 2011. So it means that balance would have been 9,000 from the start, plus the total that was charged for the year, 8,100. So that would give us 9,000 plus 8,100, 17,100. Okay, where else did we see that figure? Oh yeah, that would be the balance at the end of the year, also in the provision for depreciation account for that given year. And what would be the net book value? Now the net book value would be the cost, which is 90,000, minus or subtract or deduct the balance on depreciation, 17,100. That would give us 72,900. All right. Again, we did that working before. Let's go again. Now we were not required to do any calculation for 2012, but just for practice, for fun, let's do it. Cost 90,000, depreciation to date. Now if we're in 2012, we're going to check all the depreciation. We had 9,000 to begin, we had 8,100 for 2011, then we also had 7,290 for 2012. So if we add these three figures together, that would give us a total of 24,390. All right, let's verify. All right. Again, that should be the same balance in the provision for depreciation account at the end of the year. 2012, that is. And again, the net book value is equal to the cost minus the balance on depreciation in the balance sheet, and that would give us a total of 65,610. Again, we saw that when we were calculating depreciation expense earlier on up, after you subtracted all the depreciation, you ended up with that same figure. All right, thank you for viewing.